Welcome back to FX Street. It's 8 a.m. Eastern. Today is Thursday, March 29th, 2012. Welcome back, one and all. Great you could join us. Should see the mouse moving around the chart and hopefully hear my voice coming through loud and clear. Great. Okay, good. Let's get started. In 30 minutes from now, 8:30 a.m. Eastern, U.S. GDP numbers will be released. This is a big number. There are a couple big numbers that we wait for every month. GDP number, gross domestic product, that measures the pace of growth in the country. Employment numbers and inflationary numbers, in the Federal Reserve or any central bank for that matter watches these three different economic barometers to make their decision whether to increase or lower interest rates. And based on the result of these numbers that, again, we're going to see in about 30 minutes from now, we're going to get a much better idea, not only whether the Fed is more or less likely to raise interest rates. Well, they can't cut interest rates because we're already at zero, but the likelihood of raising interest rates, but also the likelihood of quantitative easing, 3. And that, for all intents and purposes, could have an opposite effect to the markets as raising interest rates. You see, over the past couple of years, well, historically, what happens is when an economy slows down, we have monetary policy and we have fiscal policy. Fiscal policy has to do with the tax code and regulations and things of that nature that we look to Washington to determine, to establish. Monetary policy is interest rates, and the Fed has a very, very limited scope. I think that's actually the words that they use. A very limited scope as far as what they're allowed to do. Federal Reserve is mandated by Congress to moderate the level of inflation, meaning that if the economy gets too strong, prices go up too much, all of a sudden our dollars don't have as much buying power, and then the Federal Reserve raises interest rates. As they increase interest rates, those higher rates attract investment capital from outside the U.S. The U.S. dollar goes up, and then that U.S. dollar is able to buy more goods and services, which in turn combats those increasing prices. Conversely, as an economy goes into recession, the Federal Reserve will reduce interest rates in order to stimulate spending, because lower interest rates make it less expensive to buy a house, to buy a car, to buy a refrigerator, anything that we would use credit for. Well, the Federal Reserve has done this already. And historically, that's really all that the Federal Reserve has needed to do. Now, I admit that I was not watching the Fed as closely 10 years ago as I am now. But if you recall, the last time the U.S. economy really went through a severe downturn, 2001, 2, and 3, the Federal Reserve lowered interest rates down to 1%. Alan Greenspan was the president of the Fed at the time. And he kept interest rates down to 1% for about 11 months. I think it was 11 months. And that, among a few other things, not by the Federal Reserve. The Federal Reserve, as far as I know, the only thing they did was lower interest rates down to 1%. And that very, very quickly, about a year of low interest rates, helped the economy turn around and get back on its feet. Well, we've had zero interest rates, a 0 to 0.25% range for almost 4 years now. And still, the economic recovery has not been able to gain a strong foothold. Now, we can assign blame here or there. That doesn't really help us. But what the Federal Reserve has done, in addition to keeping rates near zero or at zero for 4 years, is they initiated additional stimulus plans. Now, this occurred after the TARP plan, the Troubled Asset Relief Program. That's where the Treasury put forth about $787 billion to bail out the banks and the auto companies and everything else. Aside from that, we had quantitative easing 1 and quantitative easing 2, where the Federal Reserve came in, printed more money in order to buy long-term Treasury bonds. You buy the bonds, supply and demand, the bond price goes up, the bond yield goes down. And that is another way, I don't want to say artificial, but it's an extra way of keeping yields down as low as possible for as long as possible. That 30-year Treasury bond yield is at 3.29%, and historically, that is actually a very low yield. Now, there are intended and unintended consequences that we've talked about quite a bit. The unintended consequences is that as the Federal Reserve prints so much more money, that dilutes the U.S. dollar, and in turn that makes oil and gold and a lot of commodities that much more expensive. One of the intended consequences is that the combination of very, very low interest rates and all of this extra stimulus has really sent stocks to the upside. As you can see, this chart, the Dow Jones Industrial Average, we've been hanging around 13,000 for quite a while, though. Those are multi-year highs. Now, is it logical that the Dow should be at multi-year highs when unemployment is still at, 8.2 or 8.3%, and that the GDP numbers, we would normally expect them to be higher than they are? Is the economy really strong enough to justify Dow 13,000? Well, a lot would argue no, but the Dow is up at these levels because of low interest rates and all of this extra stimulus. So now fast forward to present day. Now we have to ask ourselves a question. If the GDP number comes out, let's take a look at the expectation here. The expectation for GDP is 3.0%. This is the FX Street Economic Calendar, by the way. It's a really nice resource to have, and this updates on a real-time basis as well, which is kind of cool. The expectation is 3.0%. The previous figure is 1.8%, and there's actually a number of different increments to the GDP number. We have the preliminary, we have the intermediate, I forget what they call the intermediate, and then they have the final. But the previous result was 1.8%. That's not what we want to see. We want to see, and I believe the Federal Reserve, I can't remember exactly the exact number, but the Federal Reserve has a target, I believe, of around 3% for the economy to show some signs of improvement. We want to see, and I will have some charts to show you as well, we want to see the GDP number 3, 4, 5% in a very strong economy, even more than that. Now, to answer your question, will the euro dollar fall? Well, putting aside the euro, which again is a completely different story because we have to take a look at the euro fundamentals, let's first answer that question in terms of the dollar. What will the dollar do? Well, the expectation is 3.0% GDP, and the previous number was 1.8%. Let's say the number comes in much better than expected, 3.5 or let's say even 4%. And it shows a huge improvement from the previous reports, and we handily beat the expectations. What would that number indicate? Well, that number would indicate that the economy is really starting to progress and improve, and it is less likely that we're going to see quantitative easing 3, and it's more likely that the Federal Reserve is going to raise rates sooner than expected. Now, we expect, according to the last Fed statement, there's anywhere from, depending on the day, a 55 to an 80% chance that the Federal Reserve will raise interest rates by the end of 2014. And if the number is better than expected, they say, well, maybe we'll raise interest rates by the beginning of 2014. We always move in small increments when we talk about the expectation and the change in expectation. If the number, the GDP number, if that's better than expected, we will now expect the Federal Reserve to raise interest rates sooner than expected, and in turn that should strengthen the dollar, because the dollar moves in anticipation of higher, lower interest rates. That's the basic, function of the currency. And because the number is better than expected, we would also be less likely to expect quantitative easing 3, which is, there's an idea that maybe we're going to see another round of stimulus. And remember, quantitative easing 1 and quantitative easing 2, the unintended consequences were that it diluted the dollar because the Federal Reserve had to print more money. Well, actually, I think it was the Treasury that printed more money in order to buy these long-term Treasury bonds. But as they print more dollars, every dollar that you and I have is worth a little bit less because there's just more dollars in circulation. I always like to say it's like a stock that splits, but we don't get extra shares. We still have 100 shares of stock, but now there's extra stock out there. So each one of our shares is worth a little bit less. Same thing with the dollar. So better than expected, I would expect to see the dollar go up, and in turn I think that the euro dollar could fall. Conversely, if the number is worse than expected, then a lot of analysts and a lot of traders and a lot of speculators out there are going to say, the economy is in real trouble. That means we're definitely not going to see the Federal Reserve raise interest rates sooner than expected. We'll probably push that expectation back to the end of 2014. And will we see QE3? It's a little bit more likely. A little bit more likely, and then I would expect bond yields to go down. I would expect bond prices to go up, inverse relationship. And I would expect also to see the dollar fall, and then conversely the euro would rise. Now, in terms of the euro, there is another issue. I mean, we could have an entire discussion about the euro, and I don't want to go too far off track here. But really quickly, there was a piece of news that was reported. I think that maybe a lot of traders out there missed this piece of news. They didn't seem to make a big deal about it on Bloomberg, but I think it is a big deal. This occurred yesterday. European governments are preparing for a one-year increase in the ceiling on rescue aid to 940 billion euros to keep the debt crisis at bay, according to a draft statement written for finance ministers. Now, we all know the issue with Greece and how the EFSF and the EU and all these different European regulatory and financial bodies have come together to make sure that the debt contagion crisis in Greece does not spread to other countries that are vulnerable, like Italy, Spain, Ireland, Portugal, etc. Well, yesterday they announced that they're preparing for a one-year increase in the ceiling in the rescue aid to 940 billion euros. The euro dollar, as this news was released, immediately spiked up. Not a lot. I think it was like 20 or 30 pips, maybe 10 pips. But the initial move was to the upside. And I always like to look at the initial move because that sometimes tells us a lot. But point being is that because of this news, well, I think that it would be interpreted as a positive for the euro currency because it would be perceived that the euro maybe is a little bit more stable. It doesn't mean that the European Central Bank is more likely to raise interest rates, but I think we're less likely to see a real crisis develop if they're raising the ceiling on the rescue aid package in Europe. So I think there was a little bit of strength in the euro currency yesterday, although not a lot. And I think the primary driving force in the euro-dollar currency pair is very much the dollar. I don't think the euro is playing as significant of a role. But if we want to get a better idea of which way the market's going to go, I would certainly strongly suggest to watch the bond market. The bond market tells us a lot. The 10-year bond, and I'm going to write this in right now. By the way, the Bloomberg symbol is USGG 10-year. That's the Bloomberg symbol. If you Google that, Bloomberg symbol for 10-year government bond in the U.S., obviously. If you Google that, you'll get the same chart that we're looking at right here, and this is the link to the chart as well. Now, the chart reflects the bond yields. Right now, by the way, well, I already gave you that link. Okay, so the bond yield right now is 2.19%, and that's before the number. We're going to watch this very carefully because we want to see what the yield is after the GDP numbers are released. That tells us a lot. See, because stocks move in anticipation of higher or lower earnings. Well, let's say that the number is better than expected, the GDP number is better than expected, and the Federal Reserve is more likely to raise interest rates and less likely to give us quantitative easing 3. Remember the picture of the stock market. Why has the stock market been so strong? One of the reasons has been low interest rates. Another reason has been all the stimulus money. So conversely, or logically, we would expect that if the GDP number shows improvement, and we make the next leap, we make the connection that numbers better than expected, more likely to raise interest rates, less likely for stimulus, quantitative easing 3, I would expect the stock market to actually go down because higher interest rates tend to slow down the U.S. economy. Now, we're not raising interest rates today because the economy does not need to be slowed down. But again, we always move in very, very small increments. Is there a 50% chance that the Fed will raise rates by the end of 2014 or a 55% chance? Very small increments, but it means a lot. So I think if the GDP number is better than expected, in some way, we may, now I don't know if this would be the initial reaction. I think the initial reaction may actually see stocks go up because those of us that trade stocks will say, hey, the U.S. economy is improving, that's good. That means Apple's going to sell more iPhones. And then maybe the stock market will go up. But the long-term effect is I think the stock market will go down. If that makes any sense. We tell our children, eat your vegetables, eat your broccoli. On a short-term basis, it may not be the most popular, statement out there, but over the long term, we know it's for the better. It's for the best. Well, I think that's the same way with the stock market. The stock market in the short term wants to see a good number, GDP-wise. And I think over the long term, look, if we have a steady rise in GDP, we'll see a steady rise in stocks over the long term. But on the very short term, I think that could also be the case. But now we consider the medium term. The medium term is the fact that the stock market has been very, very strong, and that maybe we're due for a little bit of a correction. Because again, the Dow Jones Industrial Average, with the chart we're looking at right now, 13,085 in the futures. That a lot of that price has to do with zero interest rates and a lot of quantitative easing. If we start to take away that quantitative easing and we start to raise the interest rates a little bit, that should take a little bit out of the stock market. Where? I don't know. I mean, we could say Dow 9,000, Dow 12,000. That, I have no idea how to calculate that. But I know that some of the price in the stock market is due to very low interest rates. And if you take that away, well, it's like switching from 93 octane gas down to 89. The car is still going to run, but maybe it's not going to run as well as before. But getting back to the bond market, because the stock market looks for the expectation of higher, lower corporate earnings. The bond market does not care about how many iPhones Apple sells. The bond market cares about the economy, GDP, employment, CPI, those big numbers, and a lot of others in between as well. So we look at the bond yields, and we see something very interesting. We're at a 2.19% yield right now. We hit highs around 2.4% over the past couple of weeks, and that was a really nice double top going back to October of last year. In between that period of time, we saw yields hover below 2% at 1.8, 1.9%. What happened? I think it's really important to try to assign a specific economic event to movements, especially in the bond market, so we can better understand why the market's moving and anticipate what is most likely to happen. And the bond market, I would say, is the single most important instrument to watch if we're Forex traders. Stock market, it's not as related. In fact, it's not really related at all. Commodity prices, oil can affect the dollar at times, and it can affect the Canadian dollar other times, but it's not the primary driving force. The primary driving force of foreign exchange currencies is the expectation of higher, lower rates. And the bond market is a very easy way, does a very good job of translating that expectation. Now, what time is it, by the way? It's 8:17, so we got 12 minutes to go, 12 and a half minutes to go. Okay. So 2 weeks ago, the Federal Reserve met. And remember, up until this point, the Federal Reserve was saying, you know what, we're not going to see higher interest rates until the end of 2014. And the Fed funds futures, which I think comes out of Chicago, is basically the futures market that tries to guess when the Federal Reserve is most likely to raise interest rates. And the Fed funds futures 2 weeks ago, before the Federal Reserve meeting, was 55%. There was a 55% chance that the Fed was going to raise interest rates by the end of 2014. The Federal Reserve met 2 weeks ago. The Fed funds futures climbed from 55 to 60%, and I believe, if I'm not mistaken, it actually climbed much higher after that. And the reason is because there was a tiny change in the language, and we actually met for something we call our central bank reviews. If you haven't already joined us for those webinars, I really would encourage you to do so, because it's a fun time where we look at the central bank statements in as much detail as possible to try to anticipate, exactly this. What's the likelihood the Fed will raise lower interest rates? And the bond yields, that was what caused the bond yields to spike higher. there was one little piece of change in language. I'm trying to remember what it was. I can't remember for the life of me. If you compare the statements, which we did at the time, if you compare the statements, the March statement to the January statements, the change in language basically inferred that the economy is improving. We're still not out of the woods, but things are a little bit better, and there was less of a chance of quantitative easing 3, more of a chance of higher rates, a little bit sooner than expected. As a result, the bond yields went up. And bond yields, by the way, over the long term, they tend to move in the same direction as interest rates. They tend to move in the same direction as stocks over the long term, and they tend to move in the same direction as currencies. If you go to a long-term 5-year charts, remember where interest rates were prior to the financial crisis? It actually goes back to 2007. If you have the chart in front of you, by the way, you can just click on the 5-year, and you can see what we're looking at right here. The 10-year U.S. Treasury bond yield was trading at levels of over 5%, 5.15%, 5.2%, let's say 5%. The federal funds rate, the interest rate in the U.S. was at 1.525%. The 10-year bond yield was 5%. The Dow Jones Industrial Average was, in fact, I don't know, to answer your question, I think you can. I don't know Bloomberg's symbol for the euro dollar. But if you type in a comparison, I think it's INDU-:IND. This chart tells a lot. I don't know the symbol for the euro dollar. If anybody knows Bloomberg's symbol, I can't go on Google right now, but maybe if anybody has a moment to go on Google and look for the Bloomberg symbol for the euro dollar. I forget what it is. But take a look at this chart really briefly, because this really tells a lot. Take a look. We're going back to 2007. The orange line is the U.S. 10-year bond yield. The green line is the Dow Jones Industrial Average. Dow Jones Industrial Average is well into the 13,000 level. At the same time that the 10-year bond yield was 5%, at the same time the interest rates in the U.S. were 5.25%. Financial crisis hit, and this is 2007, the beginning of this chart. Financial crisis hit, and everybody said, uh-oh, we're in a lot of trouble. Federal Reserve cut interest rates, bond yields dropped very, very quickly and very significantly. Dow Jones Industrial Average dropped very significantly as well. All this was very predictable. We hit lows. The 10-year bond yield hit a low in December 2008. The stock market did not hit a low until March of 2009. And if you look at a lot of foreign exchange currency pairs, like the Aussie yen and the Aussie dollar and the Kiwi and the Kiwi dollar, those pairs that we'd logically expect to move in the same direction, they also hit a low, not exactly the low of the bond market, not exactly the low of the stock market, but very, very close. I'm guessing, I forget exactly where the lows were, but I'm guessing it's in between the lows of the stock market and bond markets. So far, this is exactly what we would have expected to happen. Bond yields collapse, stock market collapses, foreign exchange currency pairs, like the higher yielding versus lower yielding currencies like Aussie dollar, Aussie yen, they also collapsed. Then we started to recover and everything went up together. Beautiful. But what happened here? And this, by the way, is called convergence. Convergence occurs when you have two financial instruments that, we normally expect to move together. They do move together. Then we had a period of divergence. And we're talking about April 2010, that April, May of 2010, all of a sudden, stocks continued to go up, bond yields collapsed. Now, I don't remember exactly what happened April, May of 2010. I had at one point put together a really interesting article that discussed the implications of quantitative easing 1 and quantitative easing 2, and showed when each round of quantitative easing was initiated, where the stock market and bond market was, and the foreign exchange markets, and once that quantitative easing was implemented and when it ended, where the markets were at those times. I don't remember, but if I had to make a guess, I would bet a lot of money that this divergence occurred, a lot of it occurred because of quantitative easing. Because quantitative easing, what it does, they print a lot of money in order to buy long-term treasury bonds. Beautiful. Well, when they buy the long-term treasury bonds, the yields go down, which would explain why the bond yields went down. And when they buy all these bond yields to keep interest rates low, that acts as an extra stimulus to the economy, and in turn, stocks go up. So I think this divergence is a direct result of quantitative easing. Or 8:25, 5 minutes ago, by the way, to the GDP numbers. Stocks continue to rise as the bond yields went down. Now, then we had a little bit of convergence, but then again, bond yields significantly dropped. Again, I'm guessing this first level divergence, when I have a chance, I'm going to put together another article that is going to look at the divergence between the two, and this ties in directly with the Forex market as well. But then again, I'm guessing that the second divergence occurred with quantitative easing too. Now, fast forward to what we're looking at now. Go to a 6-month charts. Okay? 6-month charts shows us that this recent spike in interest rates to the upside was a result of the Federal Reserve saying, you know what, I think there's not going to be any more quantitative easing, and I think that we're going to raise rates a little bit sooner than expected because I think that the economy is getting better. All of a sudden, we had convergence. We'll go to a 1-month chart. The green line is the Dow. The red line is a 10-year bond. It doesn't really do a good job of illustrating exactly, but both were going up together. That's convergence. This is a normal economic phenomenon. Bond yields and stocks go up together. But what happened since March 19th? The bond yields have started to drop significantly because something else happened. The Federal Reserve met 2 weeks ago. Their statement caused bond yields to go up, but since bond yields have gone up, I can't remember what it was. Was it non-farm payrolls? It's the first Friday of the month. No, it can't be non-farm payrolls. There was a number of economic numbers. I can't remember what it was exactly, but basically erased a lot of the effect of the Federal Reserve meeting a couple weeks ago. In other words, as the economic numbers begin to deteriorate again, the chances of quantitative easing improve. The chances the Federal Reserve is not going to raise interest rates improve. And the next thing you know, we see divergence. So fast forward to today. In about 3.5 minutes, GDP numbers are going to be released. 2.5 minutes. What I'm going to watch, in addition to foreign exchange, what I'm going to watch is whether the bond yields and the stock market move in the same direction or in opposite direction. 10-year bond yield right now is at 2.19%. We type that in. Dow Jones Industrial Average, 13,085. That's the Dow. Those are the Dow futures. And we might as well, just to keep everything on the same sheet of music here, dollar Swissy, which is a pretty easy way to watch to gauge the strength of the dollar. We're looking at 90.86 right now, roughly, and that's prior to the prior to the GDP numbers. Let's see after the GDP numbers. If the number's better than expected, I expect bond yields to go up. I think in a short-term bond, stock prices might go up, and maybe I would expect them to go down. But then again, I think I would expect them to go up because we want to see convergence. We want to see bond yields and stocks go up together. I would also expect to see the dollar go up. If the GDP number is worse than expected, I expect bond yields to go down. Bond stock prices might go down, but then again, they might go up. And I think that that's going to tell us that's the real clue. If stocks and bonds go down together, that's normal economics. If bond yields go down and stocks go up, that tells us quantitative easing, which is not a normal, that's not a normal occurrence. It's not a normal component of the U.S. economy or of any economy. We don't normally, we might take a multivitamin, but, we don't normally take steroids. If we take steroids, we're going to get abnormally very, very strong. But that quantitative easing is basically, think of it like steroids. And the steroids are making the quantitative easing is making the bond yields go down and stocks go up. Question is, so when the bond yields go up with the stock market, the bond market goes down. Exactly right. Bond yields and bond prices go in opposite directions. If bond yields rise and the stock market does too, will the bond market fall? Well, yes, that's exactly what we just said. That bond prices and bond yields move in opposite direction. Okay, we got the numbers out over here, so let's take a look and see what we have. Okay. U.S. GDP 3.0%. That was as expected, according to the FX Street calendar. I think that's pretty much the consensus is 3.0%. The prior number was 1.8%, so it does show an improvement in line with expectations. There's also some other U.S. numbers. Initial jobless claims 359,000 versus 350, so it's a little bit higher than expected. That's not considered to be too good because more people are claiming jobless claims. So that's going to have a little bit of effect to the stock markets. U.S. jobless claims down 5,359. Let's see here. U.S. fourth quarter final GDP 3.0% versus preliminary GDP of 3.0%. We know that. Fourth quarter GDP consensus 3.2%. This is from the Dow Jones news tape, so the figure's a little bit different. It looks like more or less I'm looking at real final sales, PCE, core PCE, purchase price index. Everything is in line with expectations. I guessed exactly right. Fourth quarter profits, negative 0.5% versus 2.1% in the third quarter. So corporate profits have fallen. Gross domestic income up 4.4 versus 2.6 in the third quarter. I'm not smart enough to know what all this means, by the way. This is why we have these analysts on Bloomberg that really go through the data. But it looks like on the surface the GDP number came out as expected at 3.0%, and that does show an improvement from the 1.8% previous number. Now, remember, let's go back to our charts here, and we'll take a look at foreign exchange market now. Remember the bond yields remember all of our numbers prior to the GDP numbers? Okay, so the 10-year bond yield, remember again, bond yields move in the opposite direction as the price of the bond. But when we talk about bonds, we always talk about the yields. Bond yields tend to move in the same direction as stocks. Okay, so the bond yield was 2.19%, now 2.17%. Bond yields are falling. Dow futures were 13,085. Now 13,070. Dollar Swissy was, where was the dollar Swiss? I typed it in, 90.86. 90.86. Now 0.9084. Okay. And, obviously prices are changing. But the initial reaction, sometimes tells us something very interesting. GDP numbers came in as expected. So far, bond yields are declining. Dow Jones futures are declining. The dollar is declining. Number one, everything is moving in the same direction. And, that's what I want to see, because that tells us the economy is moving and behaving in a somewhat normal fashion, when bond yields and stocks and the currency all tend to go together. Number two, it tells us that although this number on the surface is a little bit better than I showed an improvement from the previous month, for whatever reason the market is disappointed. Maybe some other calendars were expecting, a little bit of a higher number, but this basically is a disappointment, in the sense that it's a disappointment for quantitative easing. I think this shows us that well, we're less likely to see quantitative easing. Now we could say, well, how is that possible? Because the stock market's going down, and the Dow, I should say, the Dow futures are going down, and the bond yields are going down. Doesn't that show us that, well, the economy needs help? And if the economy needs help, maybe we need quantitative easing? I would argue just the opposite. Because GDP came out at 3.0% as expected and showed a general improvement, basically what it means is that, I think that, what am I trying to say here? I think that because things are going in the same direction, bond yields and stocks and the currency is going in the same direction, it's telling us that there's less of a likelihood of quantitative easing 3. If we saw bond yields really go to the upside, then we would expect, I'm sorry, I'm mixing it up. It's actually the opposite. If bond yields go to the upside, remember, let's go back to our bond chart, and we'll explain it this way. Sometimes I even confuse myself here. Okay. Go back to sometimes we get a little bit lost here. The best way is to go back to the beginning. We go to the 10-year bond yield. Remember, yields really spiked to the upside. Here's a 6-month chart. After the Federal Reserve met 2 weeks ago, and the Federal Reserve at that time said, you know what, things are getting a little bit better, probably no QE3. I mean, they didn't say that, but that's what everybody else thought they said. Or that's how it was interpreted. Bond yields went up as a result because we had a less of an expectation of quantitative easing 3. Bond yields since then have gone back to the downside because the economic numbers have not so far backed up what the Federal Reserve said. That basically the economy looks a little bit worse than it did 2 weeks ago. Now the bond yields are going down. I think this actually puts QE3 back on the table. This is what I'm trying to say. That this indicates that we have a little bit more of a likelihood of quantitative easing 3 because bond yields are going down. Now, bond yields and stocks are going in the same direction, so it's not a perfect picture. A perfect picture would be if bond yields went down and stock prices went up. That's a symptom of quantitative easing. The fact that the bond prices and stocks are going down together, or bond yields and stock prices are going down together, tells us that the market overall is a little bit disappointed, but maybe quantitative easing 3 is back on the table. Also, we look at the currency. Dollar Swissy was at 90.86, then 90.84, now 90.81. The dollar Swissy is slowly ticking to the downside. Remember quantitative easing 3? We print more money, we print more dollars to buy long-term treasuries in order to keep those yields down, and that dilutes the dollar. The dollar tends to go down with quantitative easing. So it's not a very clear picture, but the initial reaction, I think, does tell us that I would expect bond yields to continue to move to the downside. I would not be surprised at all to see the 10-year bond fall back down, the yield to go back down to 2%. I heard an analyst recently on Bloomberg actually talk about the 10-year bond yield. He says, I forget who it was, but there are some out there that believe that the 10-year bond yield could fall down to 1.5%. 1.8% were record lows. 2% were record lows until they were broken. 1.8% were record lows until they were broken. Take a look at the 5-year charts. There's a steady trend to the downside. The lowest low, by the way, we see here is this is in a 5-year chart, so this is not necessarily going to take every little increment. 1.71% October of last year. 1.72% yield. Some analysts expect the bond yields to go down more. And by the way, if you were to very simply take a look at this bond yield chart, we could draw trend lines. It doesn't take a lot to imagine that we would draw a downtrending resistance. And that resistance, I'm guessing, is going to fall right around 3% at the high side, lower highs and lower lows all the while. What about interest rates? Well, interest rates, we draw the direct connection from yields to interest rates, meaning that we would expect them to go in the same direction. Where were interest rates in 2007? 5.25%. when the 10-year bond yield was at 5-something% as well. When interest rates fell, the bond yield fell as well. The Federal Reserve is less likely to raise interest rates if the bond yields fall to the downside. Remember again, why, do we have quantitative easing 3? Or I'm not quantitative easing 3, but why do we see QE1 and QE2? The intended consequence, the reason why we have quantitative easing was to buy long-term treasuries, to send treasury yields lower, bond yields lower. Because when bond yields are lower, it's another artificial way of making it less expensive for consumers to go out there and buy a house and buy a car and other big-ticket items to use credit. Number one, we lower interest rates. But then we buy these bonds that keeps interest rates low, that helps the 30-year mortgage rates. The 30-year mortgage rate, I think, sometime last week was at 3.8%. Now, in theory, I don't necessarily agree with the strategy because, if the Federal Reserve really wants the American public to go out there and buy a house, the fact that they put a specific timeline on their quantitative easing, and not the quantitative easing, but their monetary policy, the Federal Reserve has told us we're going to keep rates low until the end of 2014. Anybody that wants to buy a house out there does not feel rushed at all. Just say, don't worry, I'll buy a house, but you know what? I don't really feel good about the economy right now. I'm not really happy with the amount of money I'm making with my job right now. Who of us is happy with the amount of money we're making, right? I'm not going to buy a house right now. I'm going to wait. Why? I'm not worried about waiting because bond yields are not going anywhere. Interest rates are not going anywhere. Ben Bernanke just told me we're going to keep rates low until the end of 2014. I'm going to save up for a bigger down payment. What I think is one of the reasons why people buy homes is not that we have low rates, but we have low rates and then there's a risk that rates are going to start to go up soon. So I think that a better strategy for the Federal Reserve is that, these are smart guys, but I think a better strategy would not to give a specific date, an end point when the Federal Reserve expects to raise interest rates. I would more like to see the Federal Reserve say, you know what, the economy is improving, we're going to keep rates low for an extended period or for some time. Don't be so specific. For an extended period, for some time, for a given amount of time, or, we see the economy improving and maybe we're going to raise rates sooner than we thought before. If I was out there in the housing market ready to buy a house or on the fence maybe to buy a house, and then Ben Bernanke says, you know what, the economy is improving and I think we're going to raise rates a little bit sooner than we thought last month, that's going to encourage me to call up my mortgage broker and say, listen, let's try to get a closing date pushed up a little bit. Ben Bernanke is going to raise interest rates, and I want to lock in these low interest rates now. It doesn't mean that the Federal Reserve has to raise a rate. It's just a little bit of a threat. It's a friendly threat. But you know what happens? For those of us that are willing and able to buy a house, and maybe we were sitting on the sidelines, if that pushes us to buy a house, beautiful. The housing market goes up. Banks start to get back on track. They start to make some money because they see that, the housing market's starting to recover. A lot of those homes that are in foreclosure or that are underwater start to come out from underwater. We buy a house and we want to fix it up, so we go to Home Depot and we go to Lowe's and we spend a lot of money on new paint, new supplies, and new landscaping. And the next thing you know, the economy starts to, click back in the upward direction. And then the banks say, hey, the economy's getting a little bit better, and there's a lot of people that want to, buy a house. Let's make it a little bit easier for people to get out there and to, buy a house. Let's extend our lending. Let's lower our standards a little bit so we can get out there. You don't need a 900 credit score, 800 credit score, 700 credit score. Let's get out there, and facilitate this. And that will, in turn, of course, create jobs as well. The next thing you know, unemployment down to 5% and GDP is up to 5%, and we have a roaring stock market again, or we have a roaring economy again. Stock market's already roaring. I think that, and of course it's not going to happen in one day, but I think that would be the result if the Fed did not tell us, don't buy a house now. Rates are going to be low until the end of 2014. The Fed should tell us, we're not going to tell you when, but things are looking better. So if you're thinking about buying a house, you should do it soon. That's my 2 cents on the Fed. When bond yields fall, does that mean people are expecting less interest rates? Yes, it's essentially that. I mean, the bond yields are a reflection of the expectation of higher or lower rates. The true reflection is that we look at the Fed funds futures. If you go on Google, I don't know exactly what website it would be. I think it's traded on the Chicago Board of Options Exchange, the CBOE. I'm not sure though. The Fed funds futures assigns a probability. And I'm going to look at my Dow Jones tape really quickly because sometimes after big numbers they'll print this. But they essentially, let's see here, I don't see it. The Fed funds futures is the most pure way to see the expectation of higher or lower interest rates. I don't see it right now. But if you go on Google and you type in Fed funds futures, that gives you that actual probability. But to answer your question, yes. To answer your question, bond yield to move in the same direction as the expectation of interest rates. Now, getting to the foreign exchange markets, dollar Swissy, at 8:30 a.m. Eastern, there was an initial spike higher in the dollar Swissy, and now we're seeing a move back to the downside. Remember, the dollar Swissy was at 90.86, then 90.84, now we're at 90.78. What I would do is I would draw a line, a horizontal line, at the very top of this chart over here, because this tells us the highest high that the dollar Swissy was able to achieve as a result of the GDP number. Now, this does not necessarily tell us which way it's going. I mean, we can take a look at a daily chart to get a better idea. And it kind of looks like there's a steady trend to the downside in the dollar Swissy. Well, let's go to a 4-hour chart that's a little bit more specific. Here. And we can draw trend lines as follows. I think that tells a lot. That tells a lot about what we're seeing here. That if the dollar Swissy is able to break above that 90.92 high, that will tell us, for whatever reason, all of a sudden that's a parallel line. Beautiful. That will tell us that for whatever reason, now the market is a little bit more optimistic than it was prior to the GDP number. But until and only if we break above 90.92, we'll round up to 9,100 figure. But as long as the dollar Swissy stays below 9,100, the trend is your friend. In a 4-hour chart, the trend is to the downside. So I am moderately bearish, negative on the dollar Swissy, because at the end of the day, it's important what the GDP number is. It's much more important how the market behaves after the fact. We could have just looked at this number and said 3%. You could have thought it was a good number. I could have thought it was a bad number, but that's just, one man's opinion. But how the market behaves, the bond yields were 2.19%. Now they're 2.16%. The bond market's telling us, for whatever reason, we see lower yields. And also watch the 10-year bond yield. If we see it above 2.19, if you see it 2.2%, 2.21, which by the way is the high of the day, 2.21%, 2.21%. If you see it above that at 2.22, then that tells us, I think the dollar Swissy is also likely to go higher as well. With that said, I'm officially out of time. If you have any questions, you can contact me directly, www.forex.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more to talk about. Again, we thank you for joining us. We wish you a great day. All profitable trades. And we look forward to seeing you back soon. Back in